Right, thank you, Eddie. Welcome, everyone. Thank you to NewFinance and to Digital Jersey. I'm here from Ogier this evening just to give you a brief introduction from a lawyer's perspective, at least, to crowdfunding. A little bit about the changing nature of the regulatory environment that surrounds crowdfunding, and also perhaps a little look from a Jersey perspective at what that means, and then maybe, hopefully, a bit of a debate around whether that is an opportunity for us here in Jersey. I'm a corporate lawyer by training. I've spent 9 years in the City of London, and I'm now working for Ogier in Jersey, and I've been here just over a year. So I've enjoyed the damp summer like everybody else. I suppose where to start. Crowdfunding, the usual strapline, some of you probably aware, whereby individuals offer equity investment or cash loans to businesses via online platforms. I was thinking about the header for this, and I originally wrote a new world, and then I thought, no, although it is a new world, some people will say, well, of course it was born out of the financial crisis in 2008, so it's been around for a while. And so I thought, well, new world it is. And then, of course, I saw the advert from Lloyds Bank, which are advertising their 250th year, serving the business sector and the personal loans market in the UK. So I thought, well, it can't be that new. So I settled with relatively new. So I hope you all find that acceptable. Basically, money offered by individuals to and organisations to businesses, mainly traditionally start-up businesses, but since then I think it's probably become a little bit more established, and it's more developed businesses themselves, and the likes of Funding Circle and Cedars, who I've sort of advertised a little bit here, are some of the mainstream providers. There are a number now. The two main types are loan-based platforms and investment-based platforms. So you've got the traditional lending market, whereby an individual may look to lend a sum of money for a term of years. They will be expecting a return by way of interest and also their capital back at the end of that period. And also you've got the investment-based platform, which is the shares-based model, where the investors will seek to put in their capital. They'll put their capital at risk, and they will hope for a return should the company go on to develop successfully. Funding Circle is a lending-based platform, typically dealing in loans for individuals and businesses in the UK, and Cedars is the equivalent, I would say, for the equity-based model. There's an interesting debate going on at the moment around the regulation and whether or not that is chipping away at the crowd element of crowdfunding. I think probably, in the UK at least, the Financial Conduct Authority is the leader on the regulatory aspect. They've been moving in recent years to perhaps catch up with the developing marketplace and make sure that the consumers themselves are protected for essentially their own good. Of course, the way these models work is it's typically smaller individual investors staking their own personal wealth, whether it be by way of a loan or by way of equity, and they would look to put in small amounts. Companies would typically seek to raise £25,000, £30,000. Individuals may be staking anything from £50 to £100 a time. So the FCA has moved to put in consumer protections to make sure that those individuals are protected from themselves, and again, making sure that at least the companies that are taking their money are acting appropriately. Of course, the upside or the downside to that, depending on which way you look at it, is you're limiting the crowd of people that can invest. You've got high net worth individuals or self-certified sophisticated investors. They are typically the target market, if you like, rather than the sort of grannies and grandpas around the country that are looking to fritter away a few pounds on something that they're not perhaps certain about. For equity investment, they're introducing net asset tests, whereby if you take away the family home as the main asset, you look to make sure that nobody is investing in shares any more than 10% of their own personal wealth. And minimum capital standards for companies seeking investment, such as that's on the debt side, to make sure that those investing in debt are protected, so the company is seeking to utilize that money wisely. And I suppose finally it is really just, it is regulation adding legitimacy to the sector. I suppose it's an interesting debate. I know the guys at Funding Circle have said that it is, and I suppose when you go back to 2007, 2008 and the financial crisis, crowdfunding was very much something that was coming. It was new, it was unregulated, people had concerns, but it was fresh. The flip side is the additional regulation, it protects the investors, but it sort of authorises and rubber stamps what the crowdfunding platforms are doing. So there's two sides to that argument. I suppose the next logical thing to do is to sort of see what Jersey is doing about crowdfunding from a regulatory perspective. It's not perhaps as comprehensive as the position in the UK. And of course, the UK is relevant because most individuals and companies in Jersey will either invest through UK-based entities or themselves be incorporated and operating in the UK. Despite the sort of lack of joined-up thinking from the regulators over here, there are a number of existing legislative provisions that do sort of fit nicely into that parameter of crowdfunding. And I think probably the financial services law that we have here would capture any new company seeking to set up in business for a crowdfunding platform. And they would have to look carefully at whether or not they would need to have their business authorised or whether they could be exempt, and that means be exempt from the need to be authorised to undertake investment business. The investment business side relates more to perhaps the equity side of crowdfunding. Investment business essentially means dealing in securities and trading in securities and advising on the investment in securities. I think in those circumstances, companies that were looking to offer that form of crowdfunding would need to consider whether or not they would fall within the authorised bracket of the financial services law. There are sort of exemptions, as I've alluded to. Perhaps the main one is what's known as the PERS exemption. It's the Professional Investors Regulation exemption, whereby individuals, high net worths usually, will get together to invest collectively for a particular purpose. So in those circumstances, you wouldn't need to seek authorization, but it's just a kind of flag that there is quite a lot to think about when you're looking to, or if you were looking to set up some form of crowdfunding platform on the island. Other sort of relevant bits and pieces which relate to more so to the security equity side of crowdfunding platforms. Generally speaking, you would look at it on a case-by-case basis to understand who was offering the shares, whether they're being offered direct to investors, or whether indeed they're being offered through an agency, which is sort of what most of the platforms do. They act as a shop window for the companies themselves to advertise for investment, and they arrange as agent the investment from the individual consumers. But if it was relevant, then you have to think carefully about whom the offer for investment in shares is being made to. If you have a restricted circle of investors, such as an identifiable group of people who number less than 50 persons in Jersey, then you don't need to put health warnings on the investment documentation, and you don't need to seek the consent from the JFSC to the circulation of the investment documentation. So it's a lot easier. Of course, the way in which crowdfunding may work is that you're looking to target more than 50 people, and you're looking to go to more sporadic group of people rather than an identifiable group. So in those circumstances, you're likely to need some toing and froing with the JFSC. I sort of touched on the agency arrangements. Of course, it will be relevant if you're running a platform from Jersey. Is it a Jersey company that's raising the money? Is it a non-Jersey company that's raising the money? Are they doing it in Jersey? Are they doing it worldwide? Complex facts require probably a lot of input from a variety of different advisors. It's very much not a one-size-fits-all. Just to touch on the sound business practice policy of the JFSC, we had a client recently who was Chinese-backed P2P lender. They're looking to raise some money in the UK by way of an IPO, but they came to us to incorporate in Jersey. We managed to do that for them, but the JFSC, because the company didn't have a presence in Jersey, because the company didn't have any individuals with a reputation here on the island, the JFSC were very concerned as to understand what precisely the business was, what the impact would be, and whether there would be any sort of interaction with individual consumers. It turns out from their business plan that there wasn't going to be any direct interaction. The interaction is actually taking place in China. So they were happy to approve the incorporation. But it's just something to be mindful of, that if you're looking to bring something from outside of Jersey to the island, you have to have a good story and stand up to scrutiny. So I just kind of wanted to round up on what the opportunity for Jersey is. I think really thinking about it, it's certainly possible to set up an online platform in Jersey. I know we've got some companies that have done that. It would be necessary, particularly if you were doing a crowdfunding security or equity platform, then you'd have to liaise with the JFSC, you'd have to take legal and regulatory advice because of the nature of the way the regulations are drafted. It's also relevant to consider where you're promoting your business. It's unlikely that it's just going to be into Jersey. So if you're going to go to the UK, then again, you need to consider local law advice, the FCA, the rules and regulations that we've touched on, and the English law requirements. I think really as well, just a couple of sort of ideas really, more to think about moving forward with crowdfunding in Jersey. I think certainly there's a lack of consultation within the finance industry. That would be good to see a bit more joined up thinking. Increasing the debate amongst local business leaders. Is there a need for this? How do we do it? What's the roadmap going to be? And of course, off the back of that, you develop industry expertise, which is very good for the island. And you would always be minded to protect consumers as they've done in the UK, and that's what the FCA have done. And obviously reputational risk for Jersey is very important. Whatever we do, we need to make sure that it stands up to scrutiny on a global scale. And that's it from me, but if you've got any questions, please do ask now or later.
Thank you, Alex.
Thank you, Eddie.
Do we? Does anyone have a question?
Terry Cox. In other jurisdictions, we're seeing sort of disruptive financial applications and platforms like this being developed in a market-first approach. So we're seeing companies being allowed to explore and develop market sectors, and then regulation being applied to them in order to control them in a stable way. If we're going to follow this regulation-first approach, do you see that as being a big constraint on people wanting to enter that area in Jersey?
I think it's difficult. I think regulation first is sometimes almost impossible because you tend to find that the rules follow the ideas. So if you were to look at the UK as a model, they are still very much working on their regulations. They're phasing in some ideas. They are reviewing them continuously. I think what's quite useful for Jersey is, and a lot of the legislation here is based on the UK legislature anyway. So what they could do, if there was the will and the demand, would be to set a base level of regulation whereby it's tried and tested, people know as a minimum what's required, and that's good enough to get things going, and then to be reactive and to continually to review. I don't think putting comprehensive regulation in to begin with, in something like this, which is still relatively new, is a particularly flexible way to go. I think you have to.
Do you see some opportunity to create like a grace period or a period of exploration that would allow companies to start up and get some traction before we started to apply more stringent regulation?
Potentially. I think there's two things there. I think one, it depends very much what the business is doing, and it depends what the impact on the local economic environment is going to be. So if it were, putting consumers at risk, for example, because it was just deemed to be too risky, but it wasn't giving out all of the information that the investors should be receiving before deciding whether they were going to put their money in, then no, I don't think that's the right thing to do. But in circumstances where, it's a new, fairly safe, from a regulatory perspective, idea, then why not? A grace period would make sense. And in an environment like Jersey, I think it's small enough to allow businesses to do that.
Is there a baseline definition of risk already in that sector?
I don't know really if it's definable, but I think it would come down to the consumers, the people who are investing their money, and if they're not receiving the full information, risks profile about the company they're putting their money into, they're only receiving part of the story, shall we say, then I'd say that's unacceptable. But I don't know if there's a defined sort of parameter for that.
Okay, thank you.
Thanks.
Yeah, hi, Harry McRandall. I'm just wondering if you're firms like Ogier are having a dialogue with the regulator on this, and if you are, then fine, can you fill us in? If not, what would you like to be saying to the regulator? What sort of conversations would you like to be having?
Yeah, it's a good question, thank you. I think the answer is no, as far as a direct conversation it goes. Certainly at Ogier, we're not, as far as I'm aware, having any direct formal discussions. I think it takes these kind of events to start a bit of chatter around what's useful, and what's appropriate, and from that, you may find the lawyers who have more inquiries coming to their door to say, is this feasible, is this possible, what do we need to do? And then you may discover that actually you've got to go to the regulator and have that conversation. And of course, that's what's great about Jersey. It's small enough to be able to pick up the phone to the regulators and have that conversation. But I think at the moment, as far as a roadmap goes for crowdfunding and platforms like that, I don't think there's anything that's active as far as I'm aware. But there's no reason why there shouldn't be.
Ray Parker. What I'd like to know is there a lower limit to this? I mean, it seems a bit out of scale to me that, if we're talking about a couple of thousand people investing a few £100 each, it seems out of scale that, we should be talking about the full weight of regulation and investment advice and what have you. And I know perhaps it adds up to a reasonably sizable number in total, but that kind of lower level of risk that, anybody that would invest can probably afford to throw away, is there a lower limit below which an individual investment would fall below these regulations?
Yeah, I think on the equity side, you have the provisions in the law that look to the amount of people that you're offering the investments to, and currently that stands at 50 people. So if you're offering the opportunity to invest in a new venture, you may go to your friends and family and some contacts. As long as that's under 50, then I think that's fine. And there's no limit on the number of the amount of cash you can invest on that basis. I think on the debt side, I'm not sure, but I don't think it's as restrictive. The law is much more focused, certainly from the law that I've reviewed, about investment between those looking to put in cash because their capital is at risk rather than the companies themselves. It's a good point, it's a good question. But again, I think at the moment there's very little out there which regulates all of this, and that's part of perhaps a good holistic approach would be to say, these are the de minimis levels below which, we don't mind, you're good to go, as it were.
To just perhaps then rephrase it a little bit, where has the number 50 come from? Is that an up-to-date assessment of what that figure should be, or is that a figure coming forward out of antiquity?
The number 50 has been in the legislation for a while, I would say. It's been around, it's certainly not new. It may be that, as you say, it's something that should be looked at just in the context of raising money. I think, for example, in the UK, where you have an idea before it becomes a business, you can invest without worry of ramifications from the regulator. And I think it would be good if you had sort of some clearer regulations in Jersey as to what would be appropriate for those kind of circumstances. Because, if you've got a good idea and you want a small group of people to come in and fund the early stages on that, then you should be free to do so without worrying about what the legislation says. And this is not designed to prohibit that. What the legislation is designed to do is to protect the consumer, the mass consumers, the public, from companies going out and spuriously saying, here's a great investment, loan us or lend us £50,000 or £10,000 or £5,000 or less, or invest in shares in our company for similar amounts. That's what it's designed to do. It's designed to protect the mass population from unscrupulous investment schemes. The smaller businesses, I think, and the startups are, I think you're still free to do that. And that wouldn't really concern the regulators. They're just there to protect, the wider public. But it's certainly something that could be looked at again, and I think that was my point. More debate,
in your
more discussion.
hypothetical conversation with the JFSC, then.
Yeah, absolutely. I think we need to talk about it in the round and see what their appetite is for this. Yeah.
It's a very good question. In the UK, the minimum is £10. So it's like 10 quid. In Cedars, it will be 10 quid. Crowdcube, 10 quid. Anyway, Alex, thank you very much. Thank you.
Thank you.
Andrew?